Hi, we are in the fifth complete comprehensive example in the chapter Dissolution of Partnership Firm. Let's go to the example sum. Example sum. A, B, and C were partners sharing profits in the ratio of 3:1:1. On 31st March 2019, they decided to dissolve their firm. On that date, their balance sheet was. To the left of the screen, we have the balance sheet given. On the right, additional information. It was agreed that first point, A took computer at its book value in settlement of his loan. Second point, A took furniture at rupees 8,000 and debtors of rupees 2 lakh at rupees 1,72,000. The creditors of rupees 60,000 to be paid by him at this figure. Third point, B took stock in trade at rupees 70,000 and some of the sundry assets at rupees 72,000, being 10% less than book value. Fourth point, C took the remaining sundry assets at 90% of the book value less rupees 1,000 as discount and assumed the liability of a loan together with accrued interest of rupees 300, which was not recorded in the books. Last point, the expenses of dissolution were rupees 2,700. The remaining debtors were sold to a debt collection agency for 50% of the book value. We are asked to prepare the realization account, the loan by A account, partners' capital accounts, and the cash accounts. So we'll begin with the realization account, followed by A's loan account, then the partner's capital account, and finally the cash account. Any working notes we will do at the end of the sum. So let's go ahead with the solution. Solution. Realization account. Left side debit side, right side credit side. We have particulars, rupees, particulars, rupees. We'll begin by transferring the sundry assets. Two sundry assets transferred. Debtors 2,62,000 rupees. Stock 78,000 rupees. Furniture 10,000 rupees. Computer 80,000 rupees. And finally, sundry assets 1,70,000 rupees. The total of the assets transferred ₹6 lakh. Credit side of realization account, we will begin by transferring the provision for doubtful debts. By provision for doubtful debts account, 12,000 rupees. By creditors account, 60,000 rupees by loan account, 15,000 rupees. The loan by A. A has given a loan to the firm. It's an internal liability. We will open a separate account for it. The balance sheet items are done. Let's go to the additional information. The first point says A took computer at its book value in settlement of his loan. The loan is 1 lakh rupees. The loan given by A to the firm, as per the balance sheet on the liability side, it is 1 lakh rupees. And he takes computer at book value. So he takes computer at the value of 80,000. So to the extent of the computer which is taken by A loan account, to the extent of the computer account, 80,000, and we gave a computer valued at 80,000 against a loan of 1 lakh. So the firm has made a gain. So by A loan account for the gain, 20,000 rupees. Second point, A took furniture at rupees 8,000 and debtors of rupees 2 lakh at rupees 1,72,000, and the creditors of rupees 60,000 were to be paid by him at this amount. So for the assets taken over by A's capital account, furniture 8,000 rupees and debtors taken at the value of 1,72,000 rupees. Total assets taken over by partner A is 1,80,000 rupees. And for the liability of creditors taken over by A to A capital account, for the creditors which is taken over, the amount is 60,000 rupees. Let's go to point 3. Partner B took stock in trade at rupees 70,000 and some of the sundry assets at rupees 72,000, being 10% less than the book value. So by B capital account, assets taken over, stock at 70,000 rupees and some sundry assets taken over at the value of rupees 72,000. So total assets taken over by partner B is 1,42,000 rupees. Fourth point, C took the remaining sundry assets at 90% of the book value, less rupees 1,000 as discount, and assumed the liability of a loan together with accrued interest of rupees 300, which was not recorded in the books. Let's go to the working notes to find out the value at which C takes over the remaining sundry assets. So working note 1, value at which partner C takes over the remaining sundry assets. So first let's find out the book value of the remaining sundry assets. Under point 3, it says B is taking over some of the sundry assets at rupees 72,000 and this is 10% less than the book value. So its value taken over is 72,000, and this represents in the form of percentage 10% less than the book value. So it's 90% of book value. Then what is 100% of book value, or the book value itself? 72,000 multiplied by 100 divided by 90. 80,000 rupees is the sundry book value of sundry assets which is taken over by partner B. So balance book value of sundry assets taken over by partner C is equal to the total of book value of sundry assets as per the balance sheet, 1,70,000 rupees minus 80,000 book value of assets taken over by partner B is equal to rupees 90,000, and this is taken over at 90% of book value. So value at which it's taken over is 90% of 90,000 rupees minus 1,000, further rupees 1,000 as discount. So it comes up to rupees 81,000 minus another rupees 1,000, or in other words rupees 80,000. So C takes over the sundry assets at a value, remaining sundry assets at a value of rupees 80,000. So by C capital account for the remaining sundry assets at 80,000 rupees, he takes it over. And it's also given that C takes responsibility of discharge of loan plus the accrued interest. So loan plus accrued interest, which is in other words the amount of the loan is given as 15,000 rupees plus the accrued interest of 300, 15,300. Liability taken over by partner C. Last point, the expenses of dissolution were 2,700 rupees. Borne by firm, paid by firm to cash account. 2,700 rupees. The remaining debtors were sold to a debt collection agency for 50% of the book value. So buy cash for debtors realized. First, let's get the book value of the remaining debtors. And in point 2, A is taking over debtors worth 2 lakh at 1,72,000. So debtors, out of the total debtors of 2,62,000, debtors worth 2 lakh has been taken over by partner A. Remainder is 62,000 rupees, and after selling it to the debt collecting agency, the firm gets 50% of this amount. Comes up to 31,000 rupees. The additional information is done. We'll check if all the external liabilities are paid off. The creditors has been taken over by partner A, and the loan was discharged by partner C. No other external liability left. The entries are done. I'll remove the split and we can find out the gain or loss on realization. We total the Credit side first. The credit side totals to 6,20,000 rupees. The total of the debit side ₹6,78,000. So the debit side is greater, 6,78,000 rupees on both sides. By loss, transferred to A capital account, B capital account, and C capital account. The total loss, 6,78,000 minus 6,20,000 is 58,000. The profit sharing ratio is 3:1:1. On dividing by 5, we get 11,600. So for partner B and for partner C, the loss is 11,600. And for partner A, it's 11,600 multiplied by 3, which is 34,800 rupees. So this is the realization account. Next is partner's loan account. A's loan account. Left side debit side, right side credit side. Particulars: rupees. Particulars: rupees. We'll begin by bringing down the balance of A's loan account from the liability side of the balance sheet. By balance, brought down 1 lakh rupees. As per first point, A took computer at its book value in settlement of his loan. The book value of the computer is 80,000 rupees. So 2, realization account for the computer taken over, 80,000 rupees. And against a payment of 1 lakh rupees, the firm has paid only 80,000. So the firm makes a gain. The gain has to be transferred to realization account because it's a nominal account. So the amount of the gain, 20,000, will be taken to realization account itself. And the A's loan account balances. So this is A's loan account. Next, let's continue with the partners' capital accounts. Partners' capital accounts. Left side debit side and right side credit side. We have particulars: a column for partner A, a column for partner B, and a column for partner C. And again on the credit side, we have particulars: a column for partner A, a column for partner B, and a column for partner C. Let's bring down the balance of capital accounts first. By balance brought down, 2,75,000 in the case of partner A, 1 lakh rupees in the case of partner B, and 70,000 rupees in the case of partner C. There are no reserves or profits or losses to distribute. We'll move on to the realization account to find out the items of assets and liabilities taken over. On the debit side of the realization account, we have liabilities taken over. So it's by realization account. For the liability taken over, A takes away liability, total 60,000 rupees, and C takes over 15,300 rupees. And for assets taken over, on the credit side of the realization account, A takes over total sundry assets of 1,80,000. B takes over 1,42,000 rupees. And C takes over totally 80,000 rupees. Next, let's transfer the loss on realization to realization account. It's 34,800 in the case of partner A, 11,600 in the case of partner B, and 11,600 in the case of partner C. The items are done. We will find out the amount of the final settlement. In the case of A, the credit side is greater, 3,35,000 rupees. The debit side totals to 2,14,800 rupees. After subtracting 3,35,000 minus 2,14,800, we get the amount for final settlement. In the case of A, as 1,20,200. Now in the case of B, the debit side is greater. The total of the debit side, 1,53,600. The greater total on both sides, 1,53,600. And by cash account, balancing figure for final settlement, B will have to bring in cash amount 53,600 rupees. And in the case of C also, 91,600 rupees is the greater total. Debit side total is greater. And the credit side totals to 85,300. 91,600 minus 85,300, 6,300 rupees. C will have to bring in cash. So these are the partners' capital accounts. Next, let's go to the cash account. Cash account. Left side debit side, right side credit side. Particulars: rupees particulars rupees. We'll begin by bringing down the balance of cash from the asset side of the balance sheet to balance brought down. Cash balance 32,000 rupees. Next, let's go to the realization account to get the figures for payment of liabilities and amount realized from sale of assets. On the credit side of the realization, from sale of debtors, we have realized 31,000 rupees to realization for the assets realized. ₹31,000, and for expenses on realization by realization account, for the expenses 2,700 rupees. Next, let's go to the partners' capital accounts to get the final settlement. The firm pays cash to partner A. So, by A's capital account for the final settlement, it's 1,20,200 rupees. Partner B and partner C need to bring in cash to B capital account for the final settlement. Cash brought in by partner B is 53,600 rupees, and cash brought in by partner C ₹6,300. Let's check if the cash account balances. Debit side totals to 1,22,900. The credit side also totals to 1,22,900. So this is a cash account. I'll remove the split and we can view all the accounts. This is the realization account. This is partner's loan account, A's loan account. The partner's capital accounts. And the cash account followed by the working notes.